Balance day adjustments are required at the end of the period, and we call the last day of that period balance day. So that period could be the length of a month, in which case we'd be balancing our books at the end of January. Could be at the end of a quarter, in which case we'd be balancing our books at the end of March, or it could be at the end of a year, in which case we'd be balancing our books at the end of December. We could also balance our books half yearly, so we'd be doing it at the end of June and December. On balance day, it's essential that the firm closes all its revenues and expenses, balances its assets, liabilities, and owner's equity accounts, calculates its net profit, and then prepares its financial reports. So, looking at our accounting system so far, we've got our transactions, which are recorded in special journals. These are then posted to the general ledger. We then prepare a trial balance, and so far we've learned that we prepare 3 reports called the balance sheet, the income statement, and the cash flow statement. Before we can actually calculate an accurate net profit, we need to make some balance day adjustments to the trial balance. And what we're doing is making sure that net profit does not equal revenue received less expenses paid. We're trying to get revenues to make sure that the cash numbers are updated and that we have the accrual numbers. So we're trying to get revenue received to be revenue earned. And we're trying to get expenses paid to be expenses incurred. So a balance day adjustment is all adjusting entries made in revenue and expense accounts on balance day to make them equal revenue earned less expenses incurred. So what we'll do is add a little step into the accounting system. We've got the transactions going journals into ledgers and a trial balance. But before we make our reports, we're now going to do balance day adjustments. Once we've adjusted the numbers in the trial balance, we'll then go and make our financial reports, which remain the same. So looking at the trial balance, what we do is we actually prepare 2 trial balances. We have a trial balance, we do some balance day adjustments, and then we do what's called an adjusted trial balance, which will have the updated figures in it. And that is simply a list of the balance of all the firm's general ledger accounts once all balance day adjustments have been made. And just like we did with the regular trial balance, we're going to use it to make sure the total of all debit entries equals the total of all credit entries. So balance day adjustments are required for depreciation, prepaid expenses, accrued expenses, prepaid revenues, and accrued revenues. So we've already done depreciation in Chapter 13. We're going to do prepaid and accrued revenues in Unit 4. So the rest of this chapter will be devoted to prepaid expenses and accrued expenses. So using a very simple example to begin with, let's say we have a mobile phone and we prepay the phone in July, and that's for calls that will actually be made in August. So that's called a prepaid expense. So what we say is at the end of August in our balance sheet we'd actually have an asset, and what we call it is prepaid phone expense. In this case we've got an asset of $50, and the reason why is there's a resource which we control. We're allowed to use the phone to make calls. There was a past event, we prepaid our phone bill, and there'll be an inflow of future economic benefits in the form of that we can use the phone to make calls and download data. Again, looking at a slight difference, a lot of people have a mobile phone plan, and that might be where you make the calls in August, but then you don't get the bill for those calls until September. And that's a very common situation for most people with their mobile phone. So what we say is that is what's called an accrued expense. And at the end of August, in this case, we'd have a liability called accrued phone expense of $50. And the reason why that's a liability is we have a present obligation to pay back the phone company the $50 on our bill. There was a past event where we made all our calls and downloaded our data in August. And there'll be an outflow of future economic benefits whereby we'll need to pay and send out money to the phone company in order to pay our bill. So a quick summary of what we've learned in this particular presentation. When we pay cash for an expense and then actually use it or incur it, that's called a prepaid expense. However, when we incur the expense and then pay it later in the next period, that is what's called an accrued expense.